Hi, this is Randy Finney with Right Side of the Chart, and this is a market update for Thursday, December 20th, 2018. Wanted to go over the charts quickly, share my views. Not a whole lot has changed, but more so, what I'm doing today, I'm spending some time catching up on posts. I'm still behind. I'm replying to chart requests and questions and comments caught up to yesterday. I want to read one of those out, and the reason I want to do this, I want to share my thoughts because I replied to this question, and it kind of maybe give you some insight to what I'm thinking right now, where the markets are at and what's going on here. So the question, or it was more of a comment. Randy, you were calling for QQQ 152, the level 152, for like 6 months. Here we are just a hair away. I'm a little surprised at how bullish you've been lately with all leading indicators pointing down. I really think you've gotten off track lately. You've made the perfect call 6 months ago with 152 by the end of the year. You're really talented, but I think you've just gotten a little out of sync in the past couple weeks. And so my reply, first of all, before I read my reply, that may very well be the case, and I want to say that I appreciate all feedback, particularly constructive criticism. If you have opposing market views, as long and I want to thank everybody for keeping the forum civil. I won't tolerate personal attacks, useless things. So try to keep your comments productive. If they're critical, just make it constructive criticism if possible. So my reply to the response or that comment is, I've started moving from a bearish to intermediate term outlook to a bullish intermediate term outlook for exactly the same reasons you said, although I think we see it quite differently. I was expecting the markets to correct and retest the early 2018 lows for a while, and now that they have, it still appears that this area, give or take, and I'll expand on that comment, give or take, will likely contain this initial leg down in what I still think is most likely the start of a new bear market. My convictions on when or where the exact bottom will be isn't very high at this time, as price action remains clearly bearish without any signs of a bottom. And as such, the official trade ideas remain lighter than they ever have in the 7 years by far since rightsideofthechart.com was launched. As stated on many occasions, I expected that the markets would either reverse somewhat shy of those 2018 lows or undercut them in a washout move, as too many were most likely eyeing those levels. As of now, it seems that the undercut scenario is in play, and I still think that a tradable bottom is close at hand in both time, and then parentheses I said a week or so, and price, and I said in parentheses about maybe a few percentage points or so. Essentially, nothing has changed in my outlook for the market, and while that isn't necessarily a good thing, as it could reflect a certain bias and inflexibility with my analysis, that's how I see things at this time. So let's look at the charts and see where we're at. I'll get to SPY in a second. QQQ didn't have, a well-defined. We had a lot of reactions around this level here, and then we also had a spike low down here, so more of a range for the 2018 lows. But again, my expectations all along is that we'd either reverse just shy or undercut those levels to help wash out. And we'll get to S&P 500 in a minute because S&P had roughly equal lows, and the S&P is also the market. When you talk about the stock market, QQQ is about 60% technology companies. It doesn't hold any financials, so it's not really diversified in the sense like S&P 500, which is much more representative of the U.S. Economy. So here's QQQ, and let's just take a look at a couple charts going back, and again to show what my expectation was. So this chart, as all the charts, are time and date stamped down at the bottom. This is September 17th, and that's right about the day the market bottomed. The QQQs, they put in effectively a double top right around then. No, I'm sorry, it was maybe this high here, late August or so, and then about October 1st. But you can see this is where I had us going down to. Had it a little higher here, that arrow, and then I since revised and talked about the lows. Lowered that line to 154 and also highlighted the S&P 500 lows and everything else. So again, this is not, just because I was expecting this and we've gotten here doesn't mean that we have to reverse. I still said, I said back then, and I still maintain possibly beyond. We cannot rule out a crash scenario that takes the market down another 10+% from here. I would put very low odds on it. If it is going to happen, it'll happen soon. Let me tell you that. The crashes don't occur right here. They don't come after this. Crashes, all the big crashes that we've had in the market come after a period of prolonged downtrend. Right now, the financial system, or the stock market, is precarious because you have margin calls, unwinding of the big credit bubble, and everything else I've talked about in the past. But let's look at another chart here. So again, that was back in September. Here's late September, right before we topped, and this is the mid caps ETF. And I had a couple targets here. If things get ugly, and they certainly have, or if things get ugly, target one. If things get ugly, target two, and if things get very ugly, and that was, and which I still maintain, the maximum downside that I'm looking for on this leg down. Things have gotten really ugly, and again, just because they've gotten ugly doesn't mean we have to reverse. But everything is playing out exactly as I figured. It was priced into the charts. This is a very good support level. Again, that was back on September 27th. So let's look at where we are today. Go back here. So there's QQQ. Yeah, there's that 152 level. It looks like we pierced it today. We're right around in that range. We undercut. These are the lows right here. Again, it wasn't a hard bottom in QQQ. MDY, I just showed you that chart. I have not modified it. This is that same if things get ugly target zone. Now, what's happened today so far? And again, maybe we blow by it. There are no guarantees in trading. Just because I've been right up to this point doesn't mean I must continue to be right. So please factor that in. Do what you're comfortable with. Don't take a trade you're not comfortable with ever. Don't get married to a trade. Use stops. But what we have here is this is the true definition of a waterfall sell-off. This was a waterfall sell-off. And when you have that, and if you followed me for a while, you've heard me say many, many times, there's a term I made up called a momentum-fueled overshoot. And that's when you have so much velocity coming down into a trade on a position or a stock or an index that you tend to overshoot a well-defined support level, even if that support level is going to be the one that ultimately catches a security. Now, technically, yeah, we've overshot it, but I view this to be most likely a momentum-fueled overshoot. It is also a break of support, and that also puts the market in a precarious position. Maybe that momentum fueled overshoot breaks things. In other words, there's a lot of funds, individuals that now are going to get continued margin calls that have been getting hit with margin calls that are forced to sell more. You could hit a flashpoint. So I want to say this: the markets are in a very precarious position, technical posture. I've been saying that. That doesn't mean that I think the risk reward is favorable to short. There are quite a few that I've seen short in the trading room the last couple of days. And if you want to short and trail a stop, just be aware that the markets could at any day gap up on good news. And when you are this oversold, the technicals right now still have potential divergences on all of the indexes, all the major U.S. indexes, strong divergence, very oversold. And again, there are some problems, I think, some cracks in the financial system with the extreme leverage and the extreme bubble. I call the indexing bubble, and others have referred to that. Too much money piling into index funds. That trade is being unwound right now. But with that being said, this looks like a very nice setup. We have the mid caps down. Just this example, mid caps are down 20% or so. So they're pretty much in bear market territory now. I think the first drop back in 2008 was about 20%, if I'm not mistaken. But we're just a hair below a very, very well-defined. In fact, there's some reactions down low. You can see here to the left, I can move that line down a little bit. So no signs of reversal, zero signs of reversal. But again, this is where, several months back, I figured if things got ugly, we'd go. And based on the charts, what's going on in the economy, everything else, I'm still favoring that we bottom around here very soon. And to look at SPY, remember I talked about quite a bit recently. It was as my scenario started to play out, that although I was looking for a test of these 2018 lows, I said chances are you're not going to get a perfect test. So SPY undercut. Here's a low from February. There's a low from April. They're close enough. So that's the lower of the two. So we've undercut it. So if we do reverse soon, then that is that scenario where I'm sure a lot of people, and we even paused there a couple days, stepped in to buy. And if you get a nice reversal, so if you're wanting to know what would be a pretty decent buy signal, I think it would be it's hard to say. Buy signals can come in so many forms. And I can tell you this right now. This is one reason I'm taking a couple shots recently with the QQQ long trade today. I am considering adding on IWM possibly today, maybe tomorrow, also as a long. Because it's all about risk reward and probability. Those are the two things that I factor into a trade. Risk reward, meaning, are you taking an attractive risk reward ratio? Are you risking $1 loss to make $3 or more of gain potential? And then the other variable in a trade is probability of success. Going long here is certainly, or as recently, catching a falling knife. And so you run a bigger chance of getting stopped out. However, if the market reverses, or if you're waiting for some type of a buy signal, or let's say a solid evidence of a bottom, I can tell you that's probably going to come 5+% or more after the bottom is already in. You're not going to get it 1-2% off the bottom. It just doesn't happen. In this kind of move down, we've had a lot of periods where we've consolidated or the markets have turned green intraday only to go back down again. So it's a matter of taking those shots, even if you have a higher probability of being stopped out, keeping your stops relatively tight, and catch one of those bottoms, just like if you caught the top here or here or here, it was worth it. Most people didn't want to short. I posted back in January, I think it was whatever that break was, sell signal on U.S. equity markets, and I imagine most people didn't take that short because we were at all-time record highs and the market was about as bullish to some, certainly by that trend as it ever looked. But I was tracking 60-minute uptrend lines to hone in on that entry, and we got it right there. And it probably took most people to about this point to realize, oh, well, the correction's underway. But what happens there is they don't short because it's not an objective entry no more. You missed the entry. And so I imagine the majority of traders sat out and maybe they wanted to short here thinking the market was going to crash and go to zero. Same thing here. I'm sure a lot missed, and by the time they realized, we got in this choppy mess and they probably got whipsawed. So I'm looking at this in reverse. So I'd rather get in a little early, take a few pot shots. But again, my degree of confidence is reflected in the official trade ideas. And as I said, we've never, ever had so few trade ideas and for such a long period of time where we've had such light trade ideas. And it's reflective of market conditions. I've been saying for a long time, if you are not an active trader, if you are somewhat risk averse, cash is king. Finally starting to hear about it, and the media is coming out, and now a lot of people are coming out and saying it now. I doubt very many of those people were saying it right here, here, and here when the market was up here. So the same people that are telling you now, oh, cash is king, get out of the stock market, the Fed's no longer has your back, they were probably telling you to stay long or go long here is my guess. That's I'm using that sort of as a contrary indicator. There's a lot of bearishness, obviously, is ramping up pretty rapidly here. So I believe that we are very close to a tradable bottom. And I'm going to show you IWM. Get this video out to you first. I don't know. I may put this trade on. I've already marked up some targets on IWM. I'm going to keep this video that I'm doing right now for members so I can show you these targets. IWM has undercut these lows. There's actually some lows down here. We're just below, again, just like MDY I showed you earlier. MDY is a mid-cap ETF. This is a small-cap ETF. This is one of my favorites for a bounce when we'll get the bounce soon. We have this waterfall type sell-off, which I believe has taken us down with a momentum-fueled overshoot of support, which is around, give or take, it's not a hard line, but about 132.80 or so. This stop may be revised depending on where I post this as an official trade, but I'm looking for these targets up here about 139 and then about 144. So to kind of gauge from where we're at right now, if I grab, that's where we're trading right there. You're talking about a roughly 5 to 10%, 5 or 9% upside to those targets. And we'd probably shoot a little bit above that, but I like to set my targets below where I think the market is likely to reverse, help to avoid missing a fill. So now the thing about if I decide to add this today or tomorrow when we're down like this, you may get stopped out if you take it. Of course, like I said, pass on what you're not comfortable with. But for a downside risk of, let's just say right now, 1%, to make 9%, that's a 9-to-1 RR. Even if you're just looking for a bounce, if you're you can't possibly fathom the market bouncing that much, and you're looking for a move up here that's still better than 5%, so 1 to 5 RR. So to me, I'll take those all day long. Lose a dollar, risk a dollar to make 5. They stop me out, get on the next one. Again, you can't sidestep or ride out a crash. If we're going to crash 10% or more, so you don't get married to a trade. If I put this one out, I'm allowing QQQ an intraday run. That's why I used an end of day stop on the QQQ trade today. Again, if you're not comfortable with that, don't set a hard stop or use a stop on a 60-minute close. But I do suspect a washout move here, either today or possibly tomorrow. If we close red tomorrow, that could bring the futures down over the weekend, and then we could gap down on Monday, and that might be it. So I said a week ago that I expected this week to be the lows in the market. And I stand by that now, and with we'll stretch it out to Monday. If we can't get a reversal by Friday, then you can get some nervous people over the weekend and maybe a gap down on Monday with a big reversal. So we'll say at this point my outside range is Monday, but I'll still stick with this week. I think we see a most likely a bottom. But again, the trend is clearly down. There are no buy signals, and that's why I'm not loading the site with the official long trades right now. Personally, what I've been doing since last Friday, as I mentioned, scaling out of, I moved into cash and 401k accounts, long-term stuff back, 6 months or so ago. Took when I put the TLT long trade in, I moved into treasuries there, and some of that money left to rest in cash. But for the first time in many, many months, since last Friday, I've been scaling in, adding lots, and I'll continue to add those lots probably over the next week or so up to where I want to be comfortable with. It's just a bear market rally, 401k. I'm not looking to, tuck money away in the equities for a year or more. I'm looking for a bounce that probably will start out either just before the end of the year here or shortly after the end of the year. And again, probably carry us, maybe shoot for around that 10% mark or so, and then get out. But again, we'll let the charts dictate at the time. As you know, sometimes I'll revise targets on a trade, close it out early, or extend the targets if the charts tell me to. All right, so I think that's all I wanted to cover. Let me pause the video and just check. Yeah, that's pretty much it. I'll end it here with TLT. Here's one, for example. I decided to revise the final target. We had, all along T1, T2, and T3. Those were the 3 targets. I mentioned some longer-term targets were down the road, but T3 was the former final target, and a final target is usually set at, not always, but most of the time it's set at a level where I think a meaningful reaction, in other words, a trend reversal is likely, and I still maintain that with TLT. This is a very solid level. Now, why am I talking about TLT if it's closed out? Well, first of all, I mentioned when I did close it out that longer term, traders, growth and income investors might continue to just hope, raise their stops to protect profits, trail stops up and let it run. That I thought the longer term outlook or intermediate term outlook is still constructive, but that is a very solid level. Now, why is that significant? Because this jives with what I see happening in the market. For quite a while, when the market started correcting, and I pointed that out as very dangerous at the time, treasury bonds were not responding. They were falling with stocks, very unusual. But, let the charts be my guide. Both from a fundamental perspective, when I put this trade on, I said, I don't think that will last. I said, watch, if the markets continue to go down, you will see treasuries catch a flight to safety bid. And from a fundamental perspective, besides a flight to safety bid, you will see economic forecasts sharply get revised down, and the Fed will quickly move to a more dovish stance. All of that happened. That was what triggered this. And again, it was all those comments I made while the market was still falling. So now, where am I going with this? This is very solid resistance. I expect a reversal in Treasuries soon, and I may even add that TBT as a short or short TLT. What would happen? What would cause Treasuries to come down from there? A reversal in the stock market, an exit of the flight to safety bid. If the stock market starts to rally soon, people say, whoosh, we dodged that bullet. Maybe economic growth forecasts will start ticking up a little bit. The chance for a rate hike will tick up a little bit, and you'll see treasuries come back down. And so the fact that the market is now at a target I was calling for many months ago, we have TLT also at a final target where I expected a reversal, and that helps to solidify um, my views. So I just go back to those original comments I read earlier about how I try to recognize, the fact that, this is the same view that I've had for 4 or 5 months from now, that we come down to these levels in the stock market in reverse. There's a danger in there in being locked into your views. That's confirmation bias. You see what you want to see and ignore what you don't want to see, that goes against your analysis. So at this point in time, again, I know the charts look like death. The market action is awful, but I do think that the risk to reward is rapidly shifting over to the long side. And like I said, I may add that IWM trade, and I'll finish with that the video that I started yesterday. I did part one on sector coverage, some of the sectors that stand out. I'll try to get that out today to you guys as well. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.